Imagine this. You walk into a supermarket. Milk costs more. Bread costs more. Coffee suddenly feels expensive. Even basic groceries cost far more than last year. At the same time, mortgage payments rise, rent increases, businesses struggle, and suddenly everyone asks, what is actually happening? The answer begins in a room most people never see. A group of central bankers sit around a table making one difficult decision. Should interest rates go up or stay low? Sounds boring. Actually, this decision affects almost every dollar in your life. To understand why, we need to understand inflation. Imagine the economy like a giant engine. When money flows easily, people spend more, businesses grow, house prices rise, stock markets climb. Everyone feels optimistic. At first it feels amazing. But when the economy runs too hot, something dangerous appears. Inflation. Prices rise faster than wages. Your money quietly loses value. Suddenly your salary buys less food, less fuel, less freedom. That's when central banks step in, and they pull one giant lever: interest rates. Think of interest rates like brakes on a speeding car. When inflation gets too hot, rates go up. Borrowing becomes expensive. Mortgage repayments rise. Business loans become harder to afford. People spend less, and the economy slows down. Simple in theory, painful in reality, because the first people to feel pressure are ordinary families. Imagine a young couple who just bought their first home. Last year life felt comfortable. Now repayments rise, savings shrink, stress grows, and their dream home suddenly feels heavy. Now imagine a small cafe owner. Customers stop spending, bills rise, profit disappears, and survival becomes harder. Meanwhile, big corporations often survive, banks remain standing, and ordinary people begin asking, why does the system feel unfair? But here's the difficult truth. Central banks aren't trying to hurt people. They're trying to stop something worse. Because when inflation spirals out of control, prices explode, savings lose value, and everyday life becomes much harder. So central banks face an impossible choice: raise rates and hurt people today, or keep rates low and risk a bigger crisis tomorrow. There are no perfect decisions, only difficult trade-offs. But history teaches us something important. Every crisis feels permanent until it isn't. Every inflation cycle slows. Every recession eventually ends. The people who usually win, they stay patient. They think long-term, because wealth is often built during uncertainty, not comfort. So ask yourself, am I reacting emotionally, or am I thinking in years? Think in years, not headlines.